Thank you all for coming. This panel is, we're really privileged to have two genuine finance experts with us. And all conferences make a mistake, at least one mistake in their brochure. And Wally is the mistake. His bio is not in the brochure. So I'm going to give him a little bit more of an introduction. But I'll start on my left with Rob Johnson. As it says in the brochure, Rob is currently running INET, which is not to be confused with NEI. It's the Institute for New Economic Thinking, which is a major effort launched by George Soros and now several other people to rethink economics. Rob's a legitimate PhD economist and has tremendous experience both in the private and public sector, and worked at Soros Management for a number of years. And he's very much in the thick of the whole rethink the mainstream financial system challenge right now. Wally, on my immediate left, I've only had the privilege of meeting recently, kind of appeared out of the dark into the Capital Institute network. Wally spent time at Goldman Sachs and then started his own business in the finance sector, a advisory boutique that also spun out a business around financial risk management. And then he spent a year working with an organization called Better Markets, which is a very serious effort to provide expertise to the legislative process, in a sense, defending the people against the interests of the lobbyists of Wall Street through the implementation process of DoddFrank. He dedicated a year of his life to that. That's hard duty. And at the beginning of this year, joined Dimon as a senior fellow, and again, very privileged that we've come across paths and have a lot to collaborate on together. So with that, we're going to start kind of at the high level with Rob, and then Wally's going to take it down a little bit lower and share, in part, some of his experiences in the fight in Washington.
Thanks, John. I'm always kind of yearning to find an opening line when I give a talk. And 3 days ago, I was in Italy, and Mario Monti, the Prime Minister, and I were at a meeting. I've known him for quite some time, and he said, "You know, the problem is, Rob, you and I always talk about the high politics and what to do and what policy architecture, but this is all decided in the low politics." So I'm looking forward to Wally's presentation because I think Mario Monti's right. As a matter of fact, I think the title of this session in recent history is an oxymoron: governance of the financial system. Unless you think governance by omission is consistent with the title. I want to tell a story that really comes back at the finish line to this, we might call the low politics, because my study and work, particularly with the Franklin Delano Roosevelt Institute on the Financial Reform Project, suggests to me that nationally and internationally, people have known and identified what the problems were for a very long time. I worked with the Senate Banking Committee during the time of the '87 stock market crash and the savings and loan bailout, and I've stayed involved with the professionals in that dimension of civil service, and episodes like the bankruptcy of BCCI and the cross-border implications of that were thoroughly studied by the Basel Committee on Banking Supervision. Gary Shinazi at the IMF wrote a paper in 1999 about the problem that would ensue if you interfaced over-the-counter custom derivatives with too big to fail banks. This was published. I mean, there are numerous studies, some published, some unpublished, by the Financial Stability. It was called Financial Stability Forum. Financial Stability Board is the new name, which was a compilation of civil servants from finance ministries, central banks, and securities regulation arms, which has talked over and over again about the problems of too big to fail banks, what they call called in those days large, complex financial institutions, and the inability to resolve them, meaning when they look like they're failing, the inability to shut them down or create some kind of action which would penalize them. And so what I guess I'm saying is when the crisis happened in 2008, I talked to one of the people who's one of my better friends in this at the Bank of England. His name is Andrew Haldane. And I said, Andy, what did it feel like, in light of all these studies, like I've just summarized for you, to watch a crisis unfold when you saw it coming and you knew where the fault lines were and what was going to happen? He said it was absolutely miserable. And what I'm really trying to do by taking you on this tour is to suggest this is not a failure of intellect or expertise. This is a failure of politics. And it's a failure of politics that is probably most illuminated by reading Mansur Olson's book, The Logic of Collective Action, where that which represents the social good is often defeated because concentrated interests politically can overpower broad and diffuse, what you might call the common interest. When I look at the current situation on financial structure here and abroad, I always call it the Three Stooges. The Three Stooges are too big to fail financial institutions, asset overhangs, and tolerance of usury. It is rather shocking that when you study growth stocks, and the Investor's Business Daily newspaper is one that's, how would I say, designed to construct filters for prospective stock investors, that the company Visa is now listed in their top 7 stocks. I mean, out of several thousand. Now, why in God's name would Visa be considered a new growth stock at this point? And it's in large part because we do not have usury laws in the United States. And they were allowed through some elements of opacity and some elements of political coercion, which Senator Dick Durbin, you probably remember from Illinois, said the banks own the place. But when you have a society that has an inflation rate that's somewhere between 0 and 2%, what are we doing allowing these institutions, when there is trouble, to retroactively move your interest rate from 8% or 6.5% to 28.9 to 31%? That civilizations don't do that kind of stuff. But our politics tolerates that, what you might call wealth extraction, because in essence, these people made a mess and they got to fill a hole. The hole is their balance sheet. Why we tolerate housing overhangs in America, where by some measures, I've been doing a lot of work in California, but California, Nevada, Florida, parts of Ohio and Michigan, over 1/3 of the mortgages are underwater. What's happening in Southern California, in particular San Bernardino County at this time, is that people have stopped paying on their mortgages and they've stopped paying taxes. Their mortgages are so far underwater that they don't move out. When you go talk to people about why there isn't a process for restructuring, these things are all bundled into mortgage securities, and the people who run the mortgage servicers at one level, I'll speak, just don't know how to go out and collect 7,000 proxies for a particular mortgage bundle in order to allow these restructurings. At another level, the mortgage servicers own the home equity line of credit and the second mortgages, which should be wiped out to 0 in order to restructure the first mortgage, which is senior. So you have what they now call, in the parlance of complex derivatives, tranche warfare, where the different tranches of these securities are. But what happens then, and I know a number of people, big institutions, BlackRock, PIMCO, and others, will tell you that the historical data is such that if you restructure mortgages and people stay in their homes, first thing is municipalities garner more tax revenue. The community functions better. Second thing is nobody tears out the copper pipes. They maintain the house, things of that nature. And that they estimate but a mortgage is worth 20% more with a restructuring than it is with a foreclosure. And yet, with tranche warfare, we can't get to the place where we do the right thing. And ironically, while the servicers are either incompetent in the sense of they can't manage that 7,000 signatures, or conflicted because they own some of the things that should be wiped to zero, they're carrying them on their books. Why are they doing that? Because they carry them on their books so they don't have to mark down their earnings, so their bonus pools are bigger. And lo and behold, their campaign contributions can be bigger as a result. So you have a situation of dysfunction with housing overhangs that are not, how do I say, any logical, benevolent dictator would fix this very quickly, and there are unnecessary losses to the tune of 20% of the value of the housing stock that are being incurred. Then the final stooge that I talked about was the too big to fail firms, which is a very, very odd and demoralizing dimension of our financial structure. At one level, it's demoralizing to smaller and other financial firms because the big ones, when they are considered too big to fail, that anesthetizes credit default risk. They fund themselves at a lower cost. They pick up market share from the smaller institutions where you do have to price in that risk. And they are encouraged to take more leverage and grow their balance sheet more than they should because their creditors are not penalizing them with higher funding costs associated with the risks that they take, which implies bigger market share and more leverage at the big institutions implies a bigger bailout in the event of the next downturn. And as taxpayers, that's another way, as I say, the Three Stooges get at us. So I guess I'll come to an end here where I say that the politics is important. But I was just downstairs at a plenary where the gentleman from Oberlin College, Mr. Orr, was talking about where are your intervention points. And I want to suggest two, to the extent that none of us have deep enough pockets to take on Jamie Dimon's lobby, that are important. And they are both in the realm of the ideas that govern what is acceptable behavior for financial regulation and financial system design. You know, Jürgen Habermas, the German scholar, once said that powerful elites will legitimate if they can, coerce if they have to, and accommodate if they must. We can speak about their coercive capacity through their lobbying and campaign contributions and our broken political system, which affects everything, healthcare, energy, finance, and what all. But when you talk about what's going on in financial theory, there are two visions that I want to express to you that I think are important. The first one is, does a financial system take care of itself, or does it, spin off or create spillovers and externalities? Does the financial sector jeopardize the real sector, and does the interplay within the financial sector create propagation and, mismanagement on one balance sheet propagates into mismanagement on others? I think it's very simple. If you look at the state of Greece right now, something approximately the size of Rhode Island in terms of its size, scope, scale, and population is freezing up the entire world financial system because of this opaque system where a disturbance emanating from there propagates through the system and nobody knows who has what exposures. We don't confine credit default swaps to be an insurance derivative product to the size and scale of the inherent risk, meaning the outstanding amount of Greek debt. It might be 20 or 30 times that, or it might be half. We don't know. And I have a lot of interaction with regulators. They don't know either. So they're all held hostage to protecting a system which exhibits what I'll call intra-financial spillovers. If you look at the depth and the duration of this financial crisis, I think it is obvious that the spillovers to the real economy from financial dysfunction are of first order. We're talking trillions of dollars of magnitude. So what I would say in that category is if these institutions can spill over and harm other people, there are grounds for prior restraint and regulation of those institutions so that they can't do harm in that kind of heads they win, tails you lose schemata that they have all effectively lobbied for. You know, a really good financier is looking for free options. He's looking for upside for him and the downside to go to somebody else. And we have to stop that collectively. It's not a legitimate architecture. The second point, which I think is even more subtle and more difficult to overcome, John Kenneth Galbraith wrote a book called The Short History of Financial Euphoria. And in that book, he talked about how we unconsciously or perhaps consciously, out of our own emotional needs, attribute wisdom and intelligence to the financial sector. They are the nerve center, and we need them to do what you might call be the arbiters between present and future, be the allocators of capital, be the disciplinarians. Well, obviously, we're not. I heard you laughing, so I think after TARP, where they got the bailouts and the bonuses and $800 billion waved in a couple of days, and now we don't have health care or teachers anymore, I think we might suspect their suitability for such work. But underpinning what Galbraith and others talk about, we have all adopted financial models where we assume, I'm talking about a presupposition, not something derived scientifically, that the future is anchored. And then a person, what mathematicians call backward induction, a person who's anchored at a certain point in the future can play back to the present. And so in the trickery of mathematics, or what I'll call the certainty equivalent of statistical technique, we are assuming a structure that doesn't exist. We are assuming an anchor that doesn't exist, and therefore deriving, with all of this hocus pocus, a system that is inherently stable, except for one fact. When you look at the data, it's not. And when you look at, say, Robert Shiller's famous paper in the 1981 American Economic Review, he says that if you use a fundamental model for stock price estimation, you can account for approximately 18% of the variance, meaning less than 1/5 of the variance in asset prices are accountable or are attributable to the kind of influences that this fundamental framework suggests. So we are in an environment where we allow regulatory design, capital ratios, other kinds of structures, and in the era of Alan Greenspan, even the will to enforce existing rules and regulations is all contingent on a mirage that creates, like John Kenneth Galbraith's smart financiers, a false sense of security. And if we can get in our minds that this is not a stable system by assumption, and it does have the capacity to spill over and damage other people, I am confident as a society we can, zoom in on that corruption, that coercion of the lobbying experience, and take on this collective action problem and return what, there's an old song called Wrapped Around Your Finger by the Police. And he talks about how the servant will become the master. Well, we've got to take the servant and make it a servant once again. Thank you.
Hi, I'm Wally Turbeville, and like was said, I'm not in the program, but you all must know who I am. I spent about 12 years at Goldman Sachs, and then ran a couple of firms, one of which was a derivatives risk firm, and then got the bug to pay a lot of attention to financial reform in early 2010. I also spent, among other things, I did spend time working on writing essentially 50 comment letters on various proposed rules over a one-year period, which if you do the arithmetic, that was a lot of hard work. And but the one thing it enabled me to do, I actually practiced law years ago for a while too, so it would enable me to sort of understand very clearly what was going on in the various rulemakings that implement the financial reform. I now am a senior fellow at Demos, which is a national think tank on the progressive side. In my world, this is a lot about the DoddFrank Act, which is the act that was put on the books to address financial reform. Now, the DoddFrank Act solves problems that existed in 2008, so it is intended to solve exactly what happened back then. But more importantly, in my view, it's also intended to address at least part of the underlying reasons behind those problems. And to me, the underlying reasons behind those problems date from a period leading up to the Glass-Steagall Act repeal, where the banking sector, the financial sector in the United States got extraordinarily concentrated, and then in 2008 got even more concentrated as Bear Stearns, Lehman Brothers, Merrill Lynch, and one way reform exited the world in terms of independent entities, at least, and Morgan Stanley and Goldman Sachs became commercial banks as opposed to investment banks. They became commercial banks to stabilize their positions so that they wouldn't go under. So now what's happened is there's a tremendous concentration of power and market share at unprecedented levels, much more than existed in 2008. So issues like too big to fail, but more importantly, issues like the oligopolistic way that the markets work are even more prevalent today than they were even back in those days. So the Dodd-Frank Act seeks to solve some of the problems, specific problems associated with 2008, but also to carve back on that oligopolistic way of structuring ourselves. And too big to fail has a couple of provisions. One is a resolution provision that talks about the process for resolving a too big to fail bank that goes bust. I'm not going to talk about that much, but I will talk a lot about the Volcker Rule. The Volcker Rule, named for the former chairman of the Fed, addresses banks with insured deposits and access to the Federal Reserve window. The thought being that those kinds of those commercial banks are always going to be too big to fail if they have any size at all. Now, what's happened is that this group of banks, just to give you an idea, just to throw out a couple of statistics, currently, or for the last few years, with a dip after 2008, roughly speaking, the entire amount of profits generated by the U.S. economy, 33% of those profits go to the financial sector, which is an unprecedentedly large amount. Primarily, the difference between historic levels and current levels associated with the large banks and trading. Dallas Fed released a study that observed that something like 55% of all assets owned by banks are owned by the top 5 banks in the United States. So the concentration is remarkable. The Volcker Rule seeks to address that, and I'll tell you how in a minute, but it goes back somewhat to the Glass-Steagall division of banks into commercial banking, taking deposits and making loans, and investment banking, dealing with securities and derivatives markets. Another major area in the Dodd-Frank Act deals with derivatives, financial weapons of mass destruction, as it was once referred to. Derivatives are extraordinarily complex instruments. I spent several years of my life thinking about measuring risk in derivatives, and basically concluded that attempting to be something like an economist was more precise. You can't measure the damn things. So one of the issues here is derivatives are dealt with by making dealers and big companies that deal in derivatives register and rules apply, requiring all derivatives in large part to be cleared, meaning the derivatives are all transacted through a central system that manages risk, a clearinghouse, and price transparency on a pre-trade basis and a post-trade basis, so people can start understanding what's going on in the marketplace and what the prices are. But a major premise to all this is that one could simply require capital reserves of financial institutions. But how do you know how much capital reserve is required, like in the Basel process? How do you know how much capital is required if you don't know what the damn risk is? Excuse my damn again. But I'm making a point here. the fact is, if you go to JPMorgan and the London Whale, well, there was another part of the bank dealing with those same derivatives. And in the two parts of the bank, the derivatives were priced in the two parts of the bank massively differently. The risk was. There's a Princeton professor named Brunnermeyer who's done a piece that observes that within major banks, derivatives can be priced as much as 17% differently in different parts of the banks on a regular basis. I don't think either one of them got it right. It's all wrong. So the point here is a lot of the pricing of derivatives, you understand, is not by going and looking at a market price, but by asking the trading desk what you think the thing's worth. Think about that. You ask the trading desk what you think the thing's worth. There is a little bit of conflict of interest there. So the point here is that if you're going to require capital for everything and you don't know how to measure it, how much capital do you need? Problem. So you actually have to change people's behavior, change what they actually do. So right now, you thought there was a big fight when DoddFrank was passed. Ha ha. The fight is much bigger now. It's the implementation process, and there's a tremendous battle going on through rulemaking. And I deal with this on a daily basis, and I'd like your help. Basically, the lobby, which is a tremendous force in Washington, the banking lobby has a four-part plan. They go to regulators, hundreds of meetings with regulators, SEC, CFTC, Treasury, Fed, every OCC, every letter in the alphabet combined in infinite combinations. They go to the regulators, they lobby them, but they also deal with funding because the regulators depend on Congress for funding. So there's also legislation the process that goes through. Part of that is the budgeting process. The Commodity Futures Trading Commission was a sleepy little commission that dealt a lot with oil, gas, and agricultural products. They now are going to regulate the derivatives markets. $30 trillion a year in the United States. $30 trillion. They're quadrupling their scope, and they've been cut in budget. Okay, and they can't get the budget increased from $180 million. How much does an M1A1 Abrams tank? I don't know. But it's $180 million is the budget of the CFTC. There's also been a ton of Dodd-Frank amendments put in. They're all innocuous. They're all like they're saving jobs, they're saving the economy or something. But they're actually these terrible amendments that go through the House and hopefully get stalled in the Senate. The administration is pushing back on that now finally. And there are endless oversight hearings where regulators get dragged out and waste their time explaining what's going on and what's not going on. Public relations. The whole concept of burdensome regulation is out there, right? So that's a tremendous selling point. Americans don't like burdensome regulation. So that's sort of tied into the politics of the day. And the jobs issue, you're going to, finally there's some recovery. Don't screw up the recovery by messing with the derivatives market and all the jobs that we might lose to London if the traders leave. Okay. Finally, there's litigation. Every one of these regulations has to go through some form of cost-benefit analysis, which is a murky area. The District of Columbia Circuit hears all of the cases when regulations get challenged. So it's always the banking industry challenging regulations. It's all set up for every one of the major regulations to be challenged, challenging the cost-benefit analysis they used. And the DC Circuit is, because of problems with getting confirmations, is heavily Republican. So the thought being that litigation will be a very good way to mess up things. The Volcker Rule. The Volcker Rule is not exactly like Glass-Steagall. Glass-Steagall said, no commercial banks over here, investment banks over here, never the twain shall meet. Well, the Volcker Rule doesn't quite do that. What it does is it prohibits proprietary trading. Proprietary trading is when a bank trades based so that the trading is at its own risk. It's not customer business. It's the bank taking risk. So basically, the Volcker Rule prohibits proprietary trading by commercial banks, those that are FDIC insured and get to the Fed window, for classes of securities that are stable, U.S. Treasuries, et cetera. And then has some further exceptions classes of securities are accepted, but also market making, which is customer-driven sort of, underwriting, and hedging. Hedging. The London Whale, he had another nom de guerre. I prefer Voldemort. What they were doing in London purported to be hedging. Hedging is when you have a risk and then you do something that offsets that risk. Can somebody in this audience, anybody tell me how in the world could you lose $2 billion if all you're doing is offsetting a risk? Right? It's hydraulic. So the point being, hedging has been redefined in the financial services industry as being a way to add risk onto your book and to take new positions. So there's this huge discussion that's going to ensue and is already underway on what hedging is, the whole concept of hedging. Other things that it does, the Volcker Rule recognizes that hedge fund sponsorship, remember Bear Stearns? It can be just like taking on the risk on your own book. So there are prohibitions against investment in sponsored hedge funds. They allow you to seed a hedge fund to get it going. They allow carried interest to be taken on, which is basically a profit share. But of course, a profit share is a lot like an equity investment. So there's a lot of discussion about that. And there's a de minimis level that's permitted. The primary criticisms of the Volcker Rule that are out there, I'll go to the second one first. Too complex, it's too long. You're going to hear, this is silly. This is going to sound like the 8th grade, all right? They say that the Volcker Rule is 350 pages long. The 350-page version was the double-spaced version that came out. That's not the CFR version, right? The CFR version is like 120 pages, the whole thing. What's even more important is that of the 300 pages, 85% of it is actually just commentary. So this is like, the 7th grade. I got 300 pages in, but when they say it's too long and complex, that's what it's about. And the complexity, by the way, is not about the prohibition of proprietary trading. It's about the exceptions which the banks got in. That's all the complexity is the stuff that was put in to mollify the banks. The other thing that said is it's going to damage liquidity. If you take the banks out of these markets, these proprietary traders, that there's going to be no liquidity in the markets and nobody can borrow money in the markets, and bid-ask spreads will go up and everybody will be sad. This is largely being pushed by a lot of the mutual funds, by the way, who. Now, the point being, if you're one of these entities that's covered, and you have FDIC insurance of deposits, and you have access to the Federal Reserve window, you are basically too big to fail, by definition. Therefore, when you raise capital, your capital is very cheap. So what's happening is, when everybody starts complaining about the liquidity issues, what's really going on there is that a lot of the mutual funds, money market mutual funds in particular, they actually, what they're doing is they rent the balance sheet of the banks. So what they're saying is that if the banks can't do this, the balance sheet I'm going to rent is going to be too expensive. Because what they do is they say, I've got to move $20 million worth of securities, take it off my hands. So they rent the balance sheet of the bank to do that. So what's going on there is, okay, the whole issue of damage to liquidity is pretty specious. The other thing that gets talked about is draconian results. If you violate this thing, you're going to, lightning bolt's going to come down, cast by Odin, and strike the bank dead. The Volcker Rule doesn't work that way at all. What the Volcker Rule does is set up a set of parameters, and if you violate them, in other words, if you're making too much money or too little money in doing sort of client-based activities, the bank regulators will come talk to you. And there's no penalty in the thing. So the draconian results issue is just completely specious, and they're too smart to make that case, but they do anyway. So the next the three big areas are, just go back to Volcker Rule, and then the second big area is pre-trade price transparency. This is very important. If you're talking about being able to value these derivatives, you need to know where the market is. So when they're transacted, there's clarity of market. The vast majority of these transactions in the past have been done over the phone or been done with brokers. Are there any securities brokers in the phone? Okay, derivatives, no. Brokers are supposed to get you a good price, right? My experience with brokers is they serve the interest of the people who give them the most business, which tend to be the banks. So brokers are not good price transparency. The only good price transparency is to see the market and see what people are actually transacting, and then you know where the market is and you can do your transaction accordingly. Exchanges do this, but swap exchange facilities are the things that are in the DoddFrank Act. If everything's on a swap exchange facility, is defined as something that's a web-based or other, so everybody can see what's going on. It gets competitive matching of buyers and sellers to get price transparency. It's mandated if everything that's at all liquid and is clearable has to go through these things. There's an exception for block trades, which are really big transactions that would move the market. And there's a big argument over what a block trade is, as you might imagine. And there's this whole question of the connection between swap execution facilities and clearinghouses. Okay, here's a problem. Let 1,000 flowers bloom, right? Swap execution facility is going to pop up all over the place. Here's the problem. I'm matching a trade, and the thing has to be cleared. It's like a revolving credit arrangement, the clearing. How do I know that the person I'm matching the trade with still has capacity at the clearinghouse if there are like gazillions of these swap execution facilities out there? Nobody thought about that. But it's a real issue, and it's one that has to be dealt with. And it's an issue which the big banks are saying, don't worry, each of us will front it all, right? Right. So that's not a good solution, but it's one that there's a lot of fighting over. The third big issue is jurisdiction and breadth of coverage. The whole concept of what a swap dealer is, which is subject to a lot of the heavy regulation, the final rule finally came out, and the final rule was moved very much in favor of the banks. We know that bigness shouldn't matter. If you're actually a dealer and you're doing the activity, your activity should be regulated. For instance, what can you tell a customer? But in fact, bigness turned out to matter because they were afraid of offending all the local swap dealers, I guess. The big 7 banks are covered in the rule, but we don't know yet because we don't know what the books of these companies are. The big energy companies and ag companies, think Shell, BP, all of those companies, Cargill, those companies, we don't know if they're going to be covered and swept up in the swap dealer rule yet because we won't know until it actually gets applied. The big one is extraterritoriality. This is about banks. It's about a lot of things, but one of the things it's about is branches and affiliates of banks operating in London enormously, but also everywhere else in the world. And the question is whether the rules that apply to our market are going to apply to these extra-jurisdictional affiliates. And that's unknown now, and it's a huge issue and one of great concern. The point here is if you can move everything to London, but then move all the economics of the book back to New York, what happens? You get something like what happened to JPMorgan Chase, and the punchline is they get the jobs, we get the risk. So if there's not a really good extraterritoriality rule, that's going to be the result. The JPMorgan Chase thing, Jamie Dimon is testifying this week, so it's something to watch for. Key issues: hedging or proprietary trading. What was really going on there in London? Migration of risk taking back from the London branch office back to New York, back to the U.S. Market. That's very important in thinking about extraterritorial rules. The risk will migrate back, I promise you. And the whole issue of international offices and and too big to manage, and what that all means. So these are the big issues that are going to go on. Those are the fights, and I'm in the midst of it. So any questions? Fine.
So I'm going to ask you to look into your crystal ball. Next week, Jamie Dimon is testifying. JPMorgan has the biggest lobbying force in Washington. Will he face aggressive questions, or will this be a softball hearing in light of his political power?
Okay, everybody's got to promise they're not going to mention this to anybody.
Take that away.
In my position, sometimes I get consulted by staff of senators and congresspeople. And I've had discussions with both, okay? So my thought is there's certain constraints to the hearing process. I mean, follow-up questions, those sorts of things. But I know that the staffs in both the House and the Senate are working hard to come up with just the right questions to ask on issues like the hedging issue and migration of risk and those kinds of things. So I'm cautiously optimistic.
In the era of Citizens United, feel he can ask that tough question without fearing a super PAC retribution between now and November?
Well, some of the staff members that have had interest in this have been associated with people like Senator Levin, Senator Merkley, a certain senator from Rhode Island. So people who, a certain congresswoman from California, people who are to some extent feel as if they're not as threatened by those kinds of things. So there are people who I believe, please, have the ability to ask the hard questions.
I'm sure you guys have some questions.
In a perfect world, would it be desirable to find a way to outlaw derivatives and to put a limit on the possible size of financial organizations?
I'll do it. Derivatives don't kill people, people kill people. They're derivatives that serve a good purpose. For instance, the entire commodities market relies on derivatives, which are called futures. So the answer is heavily regulated and properly priced. And in terms of size of banks, absolutely. One way or another, whether directly or indirectly, there's a bill pending Senator Brown has put out that would more explicitly reduce size of banks, but also indirectly by keeping them from doing derivatives.
I'm going to keep the questions and answers real quick. So, yes, sir.
The other big scandal recently is MF Global. I'd like to hear some thoughts on that.
The major issues there are mismanagement, I think, and just gross mismanagement and what it means when we think that these firms are managed properly. Same thing with JPMorgan, and they're not. So that's the main thing. They lost a bunch of money out of mismanagement and hubris.
I'm gonna take a chance at a question before, and then we'll come back. I have a question for you, Rob. We have in this conference a lot of discussion about the place-based economy, and one of the consequences of the concentration of the U.S. banking system is massive amounts of deposits getting sucked out of local areas and sucked onto Wall Street, and then they get invested in credit default swaps. The challenge is that the effective return on equity of small banks in real places, based on the experience of the Swiss banks, the small Swiss banks, the small Italian banks, and Tritos Bank, and what bankers have told me is that the return on equity of the real productive banking business for the real economy is under 10%. And that's before paying big bonuses to Wall Street traders. So how do we get the real economy financed by real banks? If we need to shift the real economy more to this place-based economy, if we don't have a banking system willing to operate at an 8% return on equity, do we need the state more involved in the financial system?
Well, the slipperiness of deposits that move towards the big concentrated banks and the mergers and acquisitions that allow that acquisition essentially to scoop up from the branches and take things to the money centers is undermining what is the comparative advantage of a local bank, which is knowledge of local opportunities and business entrepreneurs. A small independent bank does have fixed costs, and it needs a certain volume to bring down its average costs and to augment the profitability. And I guess my response to that in about Christmas time of 2009 was to work with Arianna Huffington and filmmaker Eugene Jarecki and my wife to found something called Move Your Money. And while it may make a small dent in things, it makes you feel like your deposits aren't used to create profits for Wall Street bonuses and lobbying funds to make sure the system stays rigged. And I know the Occupy movement's picked up a little bit on Move Your Money, but your concerns about the hollowing out of the economy, everything being New York and San Francisco, are well-founded.
Yes, sir.
I'm curious, it sounds like everybody in the financial system seems to know that people are taking risks that aren't fully disclosed and so on, and it feels like that ought to affect the value of these entities, right? These are, these are publicly traded institutions themselves. And so how does the value of these businesses hold up against what everybody in the industry knows is sort of a mirage in terms of their stability and quality of risk management?
It holds up on your back.
Yeah.
You're paying. I say that the American government right now is like a golf club where we all pay dues, but only the powerful play the course. And in essence, it's a heads I win, tails you lose structure where they're very confident that you and I, as citizens, will bear the brunt of their downside.
Yes, sir.
There's a question on hedge funds. You mentioned some limits on bank investments in hedge funds. What about the regulation of the hedge funds themselves, which seem to be completely opaque and unregulated? One of those with long-term capital nearly brought down the world financial system prior to the 2008 crisis, and I think they were involved as counterparties in the JPMorgan $2 billion loss. So is anybody thinking about regulating hedge funds?
In fact, the JPMorgan situation, the hedge funds noted that JPMorgan was so heavily invested in one sector of credit default swaps that in early April, what happened was they floated news stories so that they could pound JPMorgan because they couldn't get out of their positions. So the hedge funds in large measure.
They became long-term capital.
Yeah, exactly. So the regulation of hedge funds is there are some things that exist, but by and large, at the level of this presentation, no. The major regulation of hedge fund is to limit to 3% the involvement of the major banks. The big issue in hedge funds is the measurement issue. How do you measure risk? And that issue has not fully been addressed.
I would just add, I was actually Morgan's representative on the long-term capital oversight problem. So this was the recent financial crisis was a rerun of that, only add a few zeros. But my honest answer is that hedge funds are far better managed and controlled than these big banks, because they have creditors and they have investors that are paying attention, and they don't have a government subsidy. So hedge funds would never be allowed to do by their creditors, which are the banks, what Morgan did on that trade. So
the banks did.
I'm not saying it's not a problem, but in the scheme of things, the problem is the banks.
I've worked in this regulatory realm when I was a partner in Soros's hedge fund for many years. I'm sorry?
Louder.
And I think that your notion, what appeals to me is that we're all citizens, and if we can harm other people, we should comply with rules and regulations whereby, which you might call the systemic implications, are divulged. And I think we all play according to social rules, and we all should be registered. But as a structural priority, there are a handful of hedge funds that can bring down the system, and they need to be monitored closely. And I'm talking about 3 to 6, maybe, something like that. Well, worldwide, maybe 10 or 12. But it's really not the core of the problem. The core of the problem is that interface between the protection from the government and the big banks, and their ability to take risk with insured deposits.
And with a public stock ownership system that doesn't work because of the point you raised, that there's no ownership of public companies, accountability. So these stocks should be sold and they should be broken up, but who's going to do that? Because mutual funds all need to own them because they're all big and they're in the industry. So it's anyway, we need to break it up, but obviously we'll continue to chat.